You believe you're a stock picker. You're not. You are a ticker watcher, a headline reader, a hope and prayer investor. You see a green arrow and you feel smart. You see a red arrow and you feel a pit in your stomach. You buy a thing you don't understand, hoping to sell it to someone else for a higher price. This is not a strategy for wealth. It is a ticket to a lottery you are statistically guaranteed to lose. The system is designed to take from you, to take your time, your emotional energy, and ultimately your capital. But what if there were a different way? What if you could step outside of that chaotic, blinking casino and operate on a completely different plane? What if, instead of thinking like a gambler frantically placing bets, you started thinking like the man who owns the casino? Warren Buffett's greatest secret, the one that hides in plain sight, is that he makes no distinction between buying a $50 billion company outright and buying a few $1,000s of its stock for his personal portfolio. The mental checklist is identical. The level of rigor is the same. The core question never changes. Am I willing to own this entire business with these people, in this industry, at this price, if the stock market were to shut down for the next 10 years? This is the owner mindset. It is the single greatest intellectual leap an investor can make. It transforms you from a passive speculator into an active business partner. It replaces the frantic, high-frequency noise of the market with the low, steady hum of commerce. Today, we are not going to teach you a stock tip. We are going to permanently rewire your brain. We are going to install the operating system of a private equity titan, so that every investment decision you make from this day forward is grounded in the unshakable logic of business ownership. This is the final promise of value investing: to stop picking stocks and start buying businesses. The first pillar of this transformation, the absolute bedrock upon which this entire philosophy is built, is the conscious decision to adopt an ownership mentality and completely discard the renter's mindset. To the average person, a stock is a four-letter ticker symbol that wiggles on a screen. It's an abstraction, a digital token to be traded. To a business owner, a share of stock is a tangible, legal claim on a fractional portion of real assets, real employees, real customers, and real cash flows. This isn't just a semantic difference. It is a profound psychological schism that separates the perpetually frustrated from the perpetually wealthy. The renter looks at the price. The owner looks at the enterprise. The renter asks, "What will the stock do next week?" The owner asks, "How will this business be doing in the next decade?" The renter is a tourist, passing through. The owner is putting down roots. This shift from renting to owning is the first and most critical step in your journey. The foundational anecdote that perfectly encapsulates this pillar isn't one of Buffett's massive, headline-grabbing deals. It's a smaller, quieter acquisition that reveals the very soul of his process. It's the story of See's Candies. In 1972, Warren Buffett and Charlie Munger, through their holding company Blue Chip Stamps, were presented with an opportunity to buy a well-known, family-owned chocolate company based in California. The asking price was $30 million. Buffett's partner at the time, a man named Bob Flaherty, immediately flew out to meet with the See family and take a look at the business. He came back with a glowing report. The company had a fanatically loyal customer base. The brand was iconic on the West Coast, synonymous with quality and nostalgia. The financials were clean and consistent. It was a good business. But the price was the sticking point. See's was earning about $2 million a year after taxes. A $30 million price tag meant they would be paying a multiple of 15 times earnings. By the quantitative, deep value standards Buffett had learned from his mentor, Benjamin Graham, this was expensive. Graham taught him to buy businesses for less than the value of their working capital, to buy cigar butts with one good puff left in them for pennies. See's was no cigar butt. It was a premium Tiffany quality brand, and it was priced accordingly. Buffett's initial instinct was to pass. He offered $25 million. The See family, knowing the value of what they had built, held firm at $30 million. Buffett was ready to walk away. This is where Charlie Munger stepped in and changed the course of investment history. Munger, who had a different perspective shaped by his own experiences, urged Buffett to reconsider. He told him, "Warren, you're thinking about this all wrong. You're still stuck in the old Ben Graham framework of just looking at the numbers on the page. You need to stop thinking about a cheap price and start thinking about paying a fair price for a wonderful business." Munger saw what Buffett, at that point, was still only beginning to appreciate: the immense, unquantifiable value of a durable brand. See's had a pricing power that was almost magical. Every year, they could raise their prices slightly, and their customers wouldn't just accept it. They would happily pay it because the emotional connection to the product was so strong. People bought See's for Christmas, for Valentine's Day, as a gift of apology or celebration. It was woven into the fabric of their lives. This brand loyalty was a formidable competitive advantage, a moat that was invisible on the balance sheet but was worth more than all the factories and inventory combined. Munger convinced Buffett that paying $30 million for a business that could reliably generate increasing streams of cash flow for decades to come, with very little need for additional capital investment, was not an expense. It was a bargain. It was a classic private equity decision. They weren't buying a stock, they were buying a cash machine. They paid the $30 million. Over the subsequent decades, See's Candies has generated more than $2 billion in pre-tax earnings for Berkshire Hathaway, all while requiring minimal new capital. It was the business that taught Buffett the profound difference between a cheap company and a great company. It forced him to evolve from a, quote, stock renter, looking for statistically cheap bargains, to a business owner, looking for enterprises he would be happy to own forever. He wasn't thinking about how to flip See's Candies to another buyer in a few years. He was thinking like the See family had thought: how do we protect this brand? How do we continue to delight our customers? How do we ensure this business is stronger in 20 years than it is today? That is the ownership mentality. It's not about the ticker symbol BRK. It's about the taste of a Mary C's Bordeaux chocolate. It's about understanding the business at its most fundamental human level. This single transaction was the pivot point. It laid the intellectual groundwork for later, much larger investments in companies like Coca-Cola and American Express. It all began with the decision to stop renting and start owning, to pay a fair price for a piece of a truly wonderful business. The psychological principle that makes this mental shift so powerful is a direct countermeasure to one of the most pervasive biases in human cognition: the distinction our brains make between possession and non-possession. This is known as the endowment effect. In simple terms, people ascribe more value to things merely because they own them. A classic experiment conducted by Daniel Kahneman, Jack Nietzsche, and Richard Thaler demonstrated this perfectly. They gave half the participants in a room a coffee mug and then opened up a market. Those with the mugs were asked for the lowest price they'd sell it for, and those without were asked the highest price they'd pay. The median selling price was consistently more than double the median buying price. For the exact same mug, ownership created a massive gap in perceived value. The renter's mindset operates entirely in the pre-endowment space. A stock is just one of thousands of abstract tickers on a screen, none of which you have any emotional attachment to. This makes you fickle. It allows you to buy and sell on a whim, based on a news story or a gut feeling, because you have no deep-seated sense of ownership. You are psychologically detached. The owner mindset, the one Buffett adopted with See's Candies, is a deliberate act of pre-endowment. It's a mental trick you play on yourself to force a deeper level of commitment before times a single dollar is invested. When you force yourself to ask, "Would I be happy to own this entire enterprise for a decade?" you are artificially triggering the endowment effect. You are mentally taking possession of the company's factories, its brands, its employees, its problems. This changes everything. It elevates the stakes. You are no longer asking if a chart looks good. You are asking if you want to be in business with these people, selling these products to these customers. Suddenly, the due diligence process becomes far more personal and intense. It also engages another powerful psychological force: loss aversion. We feel the pain of a loss about twice as strongly as we feel the pleasure of an equivalent gain. For the stock renter, a 10% drop in a stock is an abstract, annoying loss of portfolio value. For the person with an owner mindset who has mentally bought the whole company, a 10% drop in the market price while the underlying business is still strong is not a loss. It is an opportunity to buy more of their own business from a panicked partner, the market, at a discount. The entire emotional framing is inverted. The renter panics and sells at the bottom, crystallizing a loss. The owner, secure in their deep understanding of the business, calmly buys more, lowering their cost basis and dramatically increasing their long-term return. This is not about being smarter, it's about having a more robust psychological framework. The owner mindset inoculates you against the market's manic-depressive mood swings. It creates an emotional moat around your portfolio that is just as important as the economic moat around the businesses you own. So how do you translate this from a nice-sounding theory into a practical, repeatable process? The blueprint is something I call the private equity memo. Before you are allowed to buy a single share of any company, you must be able to write a one-page memorandum to yourself as if you were a partner at a private equity firm like KKR or Blackstone, making the case to your investment committee for buying the entire company. This is a non-negotiable step in your new investment process. This memo must be written in plain, simple language, and it must answer 5 specific questions. First, what is the simple, one-sentence explanation of what this business does to make money? If you can't explain it to a 10-year-old, you have no business owning it. For See's Candies it would be, they make and sell high-quality boxed chocolates through their own retail stores to loyal customers, primarily on the West Coast. Simple, clear, no jargon. Second, what is the single biggest durable competitive advantage this business has that will protect it from competitors for the next 10 years? This forces you to identify the moat. For See's, it was the powerful brand and the nostalgic customer loyalty that allowed for pricing power. Third, who are the top 3 executives running this company, and what is my one-sentence assessment of their character and skill? This moves you from analyzing numbers to judging people. A key private equity skill. Are they honest? Are they skilled capital allocators? Are their interests aligned with yours? Fourth, what is a conservative estimate of what this entire business is worth today, and what price is the public market offering me a small piece for? This anchors your decision in value, not price. You must do a simple calculation of the company's earning power to arrive at a ballpark figure for the whole enterprise. We'll cover this in more detail later, but the act of doing it is what matters. Fifth and finally, what are the 2 biggest risks that could permanently impair the long-term earnings power of this business? This forces you to think pessimistically, to actively search for reasons not to do the deal. A private equity buyer is a professional skeptic. By forcing yourself to write this memo, you are short-circuiting all the worst tendencies of the average investor. You are replacing impulsive clicking with deliberate analysis. You are substituting shallow familiarity with deep understanding. The document itself becomes a record of your thinking at the time of purchase. A year later, you can review it. Was my thesis correct? Did management do what I expected? Has the moat eroded? This creates a feedback loop for learning and improvement. It is the core discipline of a professional investment process. Most importantly, the act of writing it down transforms the investment from a ticker symbol into a business you understand, a business you have mentally taken ownership of. You have endowed it with your time and intellectual energy, and you will be far less likely to abandon it during the market's inevitable storms. This single-page document is your shield. It is the constitution for your portfolio, grounding every decision in the logic of business ownership. The antithesis of this approach, the path of the 99%, is the mindset of the ticker collector. This individual doesn't own businesses. They collect ticker symbols like baseball cards. Their portfolio is a chaotic jumble of companies they know little to nothing about. They bought a tech stock because they read an article about artificial intelligence. They bought a biotech stock because a friend of a friend said it had a promising drug trial. They bought a meme stock because they saw it exploding on social media and felt the icy grip of FOMO, the fear of missing out. The ticker collector's primary source of information is the stock price itself. If it's going up, it must be a good company. If it's going down, it must be a bad one. They have outsourced their thinking to the most irrational, emotionally volatile arbiter imaginable, the collective daily whims of millions of strangers. There is no due diligence, no private equity memo, no concept of intrinsic value. There is only the ticker, the price, and the hope that it goes up. The disastrous consequence of this renter's mentality is that it makes you profoundly fragile. Because you have no deep-seated conviction based on business fundamentals, your only anchor is the price. When the price falls, as it inevitably will, your anchor is ripped away, and you are cast adrift on a sea of panic. The story of the ticker collector is always the same. They buy high, in a state of euphoria, and they sell low, in a state of terror. They might get lucky once or twice, which is the worst thing that can happen, as it reinforces a terrible process and builds a fatal overconfidence. But over the long run, the friction of trading costs, taxes, and most importantly poor decision-making at emotional extremes, grinds their capital down to dust. They will blame the market, they will blame the suits, they will blame bad luck, they will never blame their own process, because they don't have one. They are renters in a world that only rewards owners. The ticker collector who bought Pets.com in 1999 because the internet was the future, and the ticker collector who bought a speculative crypto coin in 2021 because it had a cute dog on it, are the same person, separated only by time. They are participating in a game of financial musical chairs, and they fail to realize that the music always, eventually, stops. The direct financial connection here is both immediate and profound. Adopting an owner mindset has a quantifiable impact on your portfolio's performance through several key channels. First, and most obviously, is the dramatic reduction in transaction costs. The ticker collector is constantly buying and selling, a behavior financial services firms encourage because it generates commissions and fees for them. Each trade is a small haircut on your capital. Over a lifetime, these haircuts can scalp you. The business owner, by contrast, buys with the intention of holding for years, if not decades. Their default action is inaction. This, quote, lethargy, bordering on sloth, as Buffett calls it, allows your capital to stay invested and compound without the constant drag of fees. Second is the massive advantage of tax efficiency. In the United States, investments held for more than a year are taxed at a much lower long-term capital gains rate than those held for less than a year. The ticker collector is constantly realizing short-term gains, giving up a huge chunk of their winnings to the government each year. The business owner lets their stake in a wonderful business compound tax-deferred for decades. The difference this makes over a lifetime of investing is not small. It can be the difference between a comfortable retirement and a spectacular one. It is a mathematical tailwind that the owner enjoys and the renter fights against. Finally, the greatest financial advantage is the alignment with the fundamental engine of wealth creation, the compounding of business value. A stock price can fluctuate wildly day to day, but the intrinsic value of a great business tends to grow at a much steadier, more predictable pace. By anchoring your decisions to the business, not the stock, you harness this powerful, underlying current. You are participating in the success of the enterprise itself, not just playing a side game betting on its stock price. The financial result is a portfolio of higher quality, lower turnover, greater tax efficiency, and, ultimately, vastly superior long-term returns. It is the financial manifestation of a disciplined mind. Having established the foundational mindset of an owner, we can now move to the second pillar, the 10-year test. This is the practical application of long-term thinking, a specific filter designed to evaluate business durability. A private equity buyer isn't interested in a business that's having a great quarter. They are underwriting its performance over the next decade. They are forced to ask, will this business still be relevant and profitable in 10 years? What could change in the world to disrupt it? This simple question is devastatingly effective at clearing away the noise and focusing the mind on what truly matters, a durable competitive advantage. Most investors, trapped in the renter's mindset, think in terms of days, weeks, or months. Their timeline is dictated by quarterly earnings reports and analyst price targets. The owner, applying the 10-year test, is playing an entirely different game. They are looking for businesses that are structurally insulated from the relentless pressures of competition and technological change. The quintessential story of Buffett applying the 10-year test is his investment in the Washington Post Company in 1973. This was not a calm, easy decision. The market was in turmoil, and the newspaper industry was facing a firestorm of controversy. The Washington Post, led by its courageous publisher Katharine Graham, had just broken the Watergate scandal, which would ultimately bring down a president. While this was a journalistic triumph, it made the company a political pariah. The Nixon administration was openly hostile, challenging the renewal of the Post's valuable television station licenses, which were a huge source of the company's profits. On top of this, the general market was weak, and the stock price of the Washington Post had been cut in half, falling from over $30 a share to under $20. The company's total market capitalization fell to around $80 million. To the average investor, the stock looked toxic. It was politically radioactive, facing regulatory threats. And its price was in a freefall. It was a headline-driven nightmare. But Warren Buffett wasn't reading the headlines, he was analyzing the business through the lens of the 10-year test. He asked himself the critical question, what will the Washington Post Company look like in 10 years? First, he performed a private equity-style valuation. He looked at the company's assets. It owned not just the newspaper but also 4 major network-affiliated television stations and Newsweek magazine. Buffett, with his deep knowledge of media properties, calculated the individual value of these assets. He conservatively estimated that the television stations alone were worth well over $100 million. Newsweek was likely worth another $30 to $40 million. The newspaper itself, with its powerful brand and dominant market position in the nation's capital, was certainly worth a significant amount as well. By his math, the entire business was worth at least $400 million. The stock market, in its panic, was offering to sell it to him for $80 million. This was Ben Graham's margin of safety on a grand scale. But the analysis didn't stop there. He then applied the long-term, Munger-esque filter. He asked about durability. In 1973, a major city newspaper was an extraordinary business. It had a local monopoly on news, advertising, and classifieds. If you lived in Washington, D.C. and wanted to find a job, rent an apartment, or see what was on sale at the department store, you had to buy the Post. It was an essential daily utility. This gave it immense pricing power with advertisers. The television stations were even better. They were government-licensed oligopolies. Buffett saw that these were not fleeting advantages. The internet was still decades away. He reasoned that in 10 years, the Post's dominant competitive position would likely be even stronger. The political noise around Watergate would fade, but the fundamental economic moat of the business would remain. He wasn't betting on the next quarter's earnings. He was betting on the structural economics of media franchises over the next decade. So, in 1973, Berkshire Hathaway invested nearly $11 million, buying up over 10% of the company. That investment, which the market thought was insane, would eventually be worth over $1 billion, becoming one of the cornerstones of Berkshire's fortune. It was a masterclass in ignoring short-term noise and focusing on long-term business durability. The underlying psychological principle that the 10-year test so effectively combats is known as recency bias. Our brains have a powerful tendency to give greater importance to recent events than to historic ones. We project the immediate past and present into the indefinite future. If a stock has been going up for 6 months, we assume it will keep going up. If a company reports a bad quarter, we extrapolate that into a story of permanent decline. The 10-year test is a cognitive circuit breaker. It forces you to zoom out from the pixelated close-up of the present moment. and see the vast, panoramic landscape of the business's entire history and potential future. It deliberately breaks the chain of extrapolation. For example, in the early 2000s, the stock of Blockbuster Video was performing well. A short-term thinker, subject to recency bias, would have seen growing revenues and profits and concluded it was a great investment. But someone applying the 10-year test would have had to ask, in 10 years, will people still be driving to a physical store to rent a plastic disc? That question would have led them to consider the existential threats of broadband internet, video on demand, and a tiny upstart company called Netflix that was mailing DVDs. The long-term perspective reveals threats and opportunities that are completely invisible to the short-term thinker. This bias is compounded by what psychologists call salience, our tendency to focus on items or information that are prominent and emotionally striking. A scary headline about a political threat to the Washington Post is highly salient. The boring structural fact of its local advertising monopoly is not. The 10-year test forces you to invert this. It trains your mind to ignore the salient, emotionally charged, and often transient information, and instead focus on the deep, structural, and enduring characteristics of the business. It's a form of mental discipline, a training exercise for your analytical mind. You are actively rewiring your brain to prioritize the signal of long-term value creation over the noise of short-term market sentiment. By consistently asking this question, you begin to see the world differently. You start to recognize patterns of durability. You appreciate the quiet, unsexy compounders over the flashy, speculative story stocks. You build a portfolio that is resilient not because you can predict the future, but because you have invested in businesses that are built to withstand it. To apply this principle, you need a structured mental model. Let's call it the Moat Durability Scorecard. This is a simple checklist you use during your due diligence process to systematically assess the long-term strength of a company's competitive advantage. You will score the business on a scale of 1 to 5 across 4 key categories of economic moats. The first category is intangible assets. This includes things like brands, patents, and regulatory licenses. Think of Coca-Cola's brand, or a pharmaceutical company's patent on a blockbuster drug. For the Washington Post, it was their brand's reputation for journalistic integrity and their government-issued broadcast licenses. How strong and defensible are these assets over a 10-year period? A 5 would be a globally recognized brand like Coke. A 1 would be a generic product with no brand recognition. The second category is switching costs. This is the pain, cost, or hassle a customer would have to endure to switch to a competitor. Think about your bank. Moving all your automatic payments and direct deposits is a huge pain, so you probably stick with them, even if another bank offers a slightly better deal. Enterprise software companies are masters of this. Once a company builds its entire workflow around a system like an Oracle database, the cost and risk of switching are immense. Does the business you're analyzing lock in its customers? A 5 is a business deeply embedded in its customers' operations. A 1 is a company whose customers can switch with a single click. The third category is network effects. This occurs when a product or service becomes more valuable as more people use it. Think of a social media platform like Facebook or a credit card network like Visa. Every new user on Facebook makes the platform more valuable for all the other users. Every new merchant that accepts Visa makes the card more useful for cardholders. And every new cardholder makes the network more attractive for merchants. This creates a powerful self-reinforcing cycle. Does the business benefit from this dynamic? A 5 is a dominant network, like the Visa/MasterCard duopoly. A 1 is a standalone product with no network component. The fourth and final category is cost advantages. This is the ability to produce a product or service at a lower cost than competitors, allowing for either higher profit margins or the ability to win on price. This can come from scale, like Walmart's massive purchasing power, or from a unique process or location, like a gravel pit located right next to a major construction market, minimizing transportation costs. Can this company sustainably produce things cheaper than anyone else? A 5 is a dominant low-cost producer like Costco, A 1 is a company in a commoditized industry with no cost advantage. After scoring the company on all 4 categories, you add up the points. A company with a score of 15 or higher likely has a wide, durable moat that will stand the test of time. A company with a score below 10 is likely in a brutally competitive industry where long-term profits will be hard to come by. The scorecard isn't magic, but it forces a structured, objective analysis of the very things that allow a business to survive and thrive over the 10-year horizon. The antithesis of this disciplined approach is the trend chaser. This investor has no interest in durable moats or 10-year plans. Their entire strategy is to identify what's hot right now and jump on board. They are obsessed with narratives and stories. In the late 90s, they bought anything with .com in its name. In the 2000s, it might have been solar panel manufacturers. In the 2010s, it was 3D printing or cannabis stocks. In the 2020s, it's artificial intelligence or electric vehicles. The trend chaser confuses a revolutionary technology with a good business. The internet was truly revolutionary, but most of the .com companies went bankrupt. The trend chaser buys the story without ever doing the business analysis. They don't use a moat durability scorecard. Their only metric is momentum and hype. They are drawn to companies with charismatic CEOs who promise to change the world, even if the company is burning through cash with no clear path to profitability. The fatal flaw in this approach is that industries undergoing rapid technological change are, by their very nature, the most competitive and unpredictable. They are moatless battlegrounds where today's winner is tomorrow's loser. Remember the dominant search engine before Google? It was Alta Vista. Remember the dominant social network before Facebook? It was MySpace. The trend chaser consistently buys into the peak of the hype cycle, paying exorbitant prices for companies with unproven business models and no lasting competitive advantages. When the narrative shifts or a new, better technology emerges, the stock price collapses and the trend chaser is left holding the bag. They are caught in a perpetual cycle of boom and bust, always arriving at the party just as the lights are about to come on. Their portfolio is a graveyard of yesterday's hot ideas. They fail to understand a fundamental truth that the 10-year test makes clear. It is far more profitable to own a wonderful, boring business that will be around in a decade than a speculative, exciting one that might not. The direct financial connection of applying the 10-year test is that it guides you toward businesses with superior and more sustainable returns on invested capital. A company with a wide economic moat can invest capital into projects, building a new factory, developing a new product, acquiring a competitor, and generate returns that are consistently above its cost of capital. A company in a fiercely competitive industry, a moatless business, struggles to do this. Any excess profits it earns are quickly competed away by rivals who copy its products or undercut its prices. Over time, the financial difference is staggering. Imagine 2 companies, both starting with a book value of $1 billion. Company A has a durable moat and can consistently reinvest its earnings at a 15% rate of return. Company B is in a tough industry and can only earn a 5% return on its investments. After 20 years, assuming all earnings are reinvested, Company A's book value will have grown to over $16 billion. Company B's will have grown to just $2.6 billion. The stock price will, over the long run, follow this creation of underlying business value. The 10-year test is a tool for identifying the Company A's of the world. It directly connects your investment process to the powerful underlying mathematics of compounding. By focusing on durability, you are not just avoiding losers like Blockbuster. You are systematically tilting your portfolio toward the long-term, wealth-creating compounders like the Washington Post. It transforms your portfolio from a collection of lottery tickets into a stable of thoroughbreds, each one a robust engine of capital generation. Once you have adopted the owner mindset and learned to evaluate a business for long-term durability, you must confront the third pillar, which is often the most difficult for purely analytical minds: the people equation. A private equity firm buying a company isn't just buying assets and cash flows. They are, in effect, hiring the existing management team to run their new investment. This means they spend an enormous amount of time judging the character, talent, and integrity of the CEO and their top executives. Buffett puts it simply, we try to associate with people who are both talented and honest. For the average stock investor, management is an afterthought. They might know the CEO's name, but they have no real sense of their capabilities or, more importantly, their trustworthiness. This is a colossal mistake. Over the long term, the quality of management is one of the most significant determinants of a company's success or failure. A brilliant management team can navigate a mediocre business to a decent result, but a poor management team can run even the greatest business into the ground. The ultimate Buffett anecdote on betting on the person is the story of Nebraska Furniture Mart and the legendary Rose Blumkin, better known as Mrs. B. This wasn't a stock purchase, it was a private equity deal that reveals everything about Buffett's focus on people. In 1983, Mrs. B was 89 years old. She was a Russian immigrant who had arrived in America unable to speak English and had started a furniture business in the basement of her husband's pawn shop in Omaha in 1937 with a $500 loan. Through sheer force of will, relentless hard work, and a simple business philosophy of sell cheap and tell the truth, she had built Nebraska Furniture Mart into the single largest home furnishing store in the United States, doing over $100 million a year in sales. She was a local legend, a terrifyingly effective businesswoman who could outsell and outwork competitors half her age. Buffett had been a customer for years and admired her from afar. One day, he went to see her and made her an offer. He said in essence, "Mrs. B, I want to buy your business. You tell me what you think it's worth, and I'll write you a check." There were no armies of investment bankers. No months of due diligence. No complex valuation models. Mrs. B thought for a moment, scribbled a number on a piece of paper, and pushed it across the table. The price was $60 million. Buffett looked at it and said, "Okay." He asked to see her audited financials. She replied that she didn't have any. He asked to check her inventory levels and receivables. She had no formal records of those either. The entire deal, for a $60 million company, was done on a handshake, based on Buffett's absolute trust in Mrs. B's integrity and his first-hand knowledge of her business acumen. He gave her a check for $60 million, and she gave him a 2-page document that constituted the entire purchase agreement. The story gets even better. Mrs. B, though she had sold the business, had no intention of retiring. She continued to work at the store, from open to close, 7 days a week, well into her hundreds. She signed a non-compete agreement as part of the sale, but at age 95, after a dispute with her grandsons who were then running the business, she quit in a huff and, in defiance of her non-compete, started a rival furniture store right across the street called Mrs. B's Clearance and Factory Outlet. It immediately became a massive success, siphoning off business from the store Buffett now owned. Most corporate owners would have sent in the lawyers. Buffett, recognizing he was dealing with a unique force of nature, did the opposite. He went back to her, bought her new, competing business, and happily folded it back into the original company. He knew that the value wasn't in the buildings or the inventory, it was in Mrs. B. He was in the Mrs. B business. This story is the extreme example of the principle. When you find a manager with extraordinary talent and unimpeachable integrity, you bet on them. You are not just buying a collection of assets. You are partnering with a proven value creator. The psychological principle at play here is a defense against our vulnerability to the halo effect and authority bias. The halo effect is a cognitive bias, where our overall impression of a person influences how we feel and think about their character. A CEO who is charismatic, speaks confidently on television, and is celebrated on the cover of magazines, is often given a halo. We assume they must also be brilliant, honest, and a great capital allocator. We mistake style for substance. Authority bias is our tendency to attribute greater accuracy and importance to the opinion of an authority figure. CEOs, by their very title, are authority figures. We are hardwired to want to believe them when they lay out their grand vision for the company's future. The amateur investor falls for this all the time. They listen to the quarterly conference call, hear a smooth-talking CEO, and think, wow, this person really has it together. They don't do the hard work of verifying those claims. They are seduced by the performance. A rigorous process for judging management is designed to break this spell. It forces you to become a skeptic, to look past the halo and question the authority figure. It's about developing what we might call a trust but verify mindset. You assume the CEO is a brilliant salesperson. Their job is, after all, to sell you on the company's prospects. Your job is to be the skeptical private equity buyer who looks past the sales pitch and examines the actual track record. Did they do what they promised to do 5 years ago? How have they allocated the company's profits? Have they enriched themselves at the expense of shareholders? These are the questions that strip away the halo and reveal the true substance of the person in charge. It's about replacing a passive celebrity worship model of management analysis with an active, forensic, and deeply skeptical one. It requires you to be a bit of a detective, piecing together clues from various sources to form a mosaic of a manager's true character and competence. The blueprint for applying this is what I call the management integrity audit. This is a checklist of tasks you must perform to move beyond the superficial impression of a CEO. First, you must read the last 5 years of the chairman's or CEO's letter to shareholders from the company's annual reports. This is the single most important document for understanding the mind of the person in charge. Is the letter clear, candid, and straightforward, like Buffett's famous letters? Or is it full of corporate jargon, buzzwords, and self-congratulatory nonsense? Does the CEO openly admit mistakes, or do they blame every setback on external factors? A great manager writes like a business owner talking to their partners. A bad manager writes like a PR firm trying to spin a narrative. Second, you must meticulously analyze the compensation section of the company's proxy statement. This document reveals exactly how the top executives are paid. Are their bonuses tied to metrics that actually create long-term shareholder value, like return on invested capital or growth in intrinsic value per share? Or are they rewarded for short-term, easy-to-manipulate metrics like sheer size or quarterly earnings per share targets? Look for huge salaries, excessive perks, and stock option plans that massively dilute existing shareholders. A management team that is paying itself extravagantly, regardless of performance, is not your partner. They are your counterparty. Third, listen to the last 4 quarterly conference call transcripts. Don't just read the CEO's prepared remarks. Pay close attention to the Q&A section, where analysts ask tough questions. Is the CEO evasive or direct? Do they demonstrate a deep, granular understanding of the business, or do they deflect to the CFO? Do they speak in clear, simple terms, or do they hide behind complexity? Fourth, investigate the CEO's track record of capital allocation. This is the most important job a CEO has. Look at their history of acquisitions. Have they consistently overpaid for empire-building deals that destroy value? Look at their share buyback history. Do they repurchase shares intelligently when the stock is cheap? Or do they buy them back at market highs to prop up the stock price? A CEO who is a master capital allocator can create immense value over time. One who is not can destroy it just as quickly. Completing this 4-part audit will give you a portrait of the management team that is vastly more accurate than any magazine profile. It's hard work, which is why almost no one does it and which is why it provides such a significant edge. The antithesis of this disciplined approach is the CEO worshipper. This is the investor who falls in love with a charismatic, visionary leader and bets the farm on them, often with little regard for the underlying business or its valuation. They are captivated by the story. They see the CEO on TV, read their biography, and become a true believer. The CEO can do no wrong. Every pronouncement is gospel. This is incredibly dangerous. The landscape of business history is littered with the wreckage of companies led by charismatic visionaries who were ultimately terrible business managers or, in some cases, outright frauds. Think of Adam Neumann at WeWork, a master storyteller who convinced the world's most sophisticated investors that an office rental company was a world-changing tech platform, all while it was hemorrhaging cash. Think of Elizabeth Holmes at Theranos, whose compelling vision and personal narrative masked a massive technological fraud. The CEO worshipper gets swept up in the cult of personality. They ignore red flags in the financial statements. They dismiss concerns about corporate governance. They believe so strongly in the leader that they abandon all critical thinking. When the story inevitably falls apart, they are the last ones to leave, often riding the stock all the way to zero, feeling betrayed and confused. They fail to understand that in investing, you should never outsource your thinking, especially not to the person with the most to gain from selling you a story. The management integrity audit is the antidote to this hero worship. It forces you to be a cold-eyed analyst, not a starry-eyed fan. The direct financial connection of this pillar is rooted in the concept of capital allocation as a force multiplier. A company's profits can be thought of as a stream of cash that the CEO gets to reinvest every year. How they choose to deploy that cash has a monumental impact on the long-term value of the enterprise. Let's say a company generates $100 million in profit. The CEO has 5 choices: reinvest it back into the business's existing operations, acquire another company, pay down debt, pay a dividend to shareholders, or buy back the company's own stock. A brilliant capital allocator, a Mrs. B or a Warren Buffett, will look at these 5 options and consistently choose the one that will generate the highest long-term return for the owners. They will only reinvest in the business if the returns are high. They will only make an acquisition if the price is sensible. They will only buy back stock when it is trading below its intrinsic value. A poor capital allocator will do the opposite. They will empire build, making overpriced acquisitions to grow the company for the sake of growth, which is good for their ego and pay package but bad for shareholders. They will buy back stock at inflated prices to hit a quarterly earnings target. Over a decade, a CEO who consistently makes brilliant capital allocation decisions can add tens of billions of dollars of value to a company above and beyond its operating performance. A CEO who makes poor ones can take a wonderfully profitable operating business and produce mediocre or even negative returns for its owners. By focusing on the people equation, you are ensuring that the person at the helm of your investment is steering the ship toward the port of higher returns, not into the rocks of value destruction. This brings us to the 4th pillar, the one that ties all the others together into a final investment decision: the price versus value disconnect. You can find a wonderful business with a durable moat and a brilliant management team, but if you pay too high a price for it, your returns will be mediocre at best. The entire game of value investing hinges on a single, powerful concept famously articulated by Ben Graham. Price is what you pay. Value is what you get. The goal is to buy a slice of a business for a price that is significantly below your conservative estimate of its intrinsic value. This gap between price and value is what Graham called the margin of safety. It is the cushion that protects you from bad luck, errors in judgment, and the vicissitudes of the economic world. A private equity buyer lives and breathes this concept. They would never dream of buying a company without first performing a rigorous analysis to determine what it's worth and then trying to buy it for less. Yet, the average investor rarely, if ever, even attempts to calculate the value of the business they are buying. They are fixated on the price and its recent momentum, with no anchor in underlying reality. The foundational anecdote for this pillar is one of Buffett's most brilliant and daring investments, American Express during the salad oil scandal of 1963. American Express at the time was not just a credit card company. A huge and profitable part of its business was in warehousing. They would store goods for companies and issue warehouse receipts, which the companies could then use as collateral to get loans from banks. It was a business built entirely on trust. A swindler named Tino DeAngelis, a New Jersey-based commodities trader, exploited this system. He had huge tanks at the American Express warehousing facility in Bayonne, New Jersey, supposedly filled with valuable salad oil. But he had a scam. The tanks were mostly filled with water, with only a few feet of oil floating on top. When inspectors would dip their measuring sticks in, they would come up coated in oil. Based on these fraudulent receipts, DeAngelis borrowed over $150 million from dozens of banks, a colossal sum at the time. When the fraud was discovered, he defaulted, the salad oil was revealed to be mostly water, and the banks, holding worthless collateral, turned to American Express to make them whole. Wall Street panicked. The thinking was that American Express, whose entire brand was built on financial integrity, would be on the hook for the entire $150 million in losses. This was a company that had only earned about $15 million in the previous year. A loss of that magnitude could wipe them out. The stock price was annihilated, collapsing by nearly 50% in a matter of months. It looked like the end for this blue-chip institution. This is where Warren Buffett, then a young, relatively unknown money manager, saw not a crisis but an opportunity. He refused to be swept up in the panic. Instead of focusing on the stock price, he did the work of a private equity buyer to determine the intrinsic value of the business. He broke the problem down. First, he questioned the liability. Would Amex legally be forced to cover all the losses? The answer was murky. But Buffett went further. He went out and did his own primary research, his scuttlebutt. He went to banks, to merchants, to restaurants. He talked to them about their relationship with American Express. He asked a simple question. Now that this scandal has happened, have you stopped accepting American Express cards or traveler's checks? The answer, universally, was no. He discovered that the core businesses, the credit card and the traveler's checks, were completely unaffected by the warehousing scandal. Their customers and merchants still trusted them. He realized the franchise had an immense, powerful brand that the market was completely ignoring. He calculated that the fundamental earning power of these core businesses was still intact and was worth far more than the current, panicked stock price suggested, even if they had to pay the full $150 million liability. He estimated the value of the business was around $60 per share, and the market was offering it to him for $35. He had a massive margin of safety. Buffett famously invested 40% of his partnership's capital, a huge bet, into American Express stock. His analysis proved correct. The company weathered the storm, its ultimate liability was far less than feared, and the stock price roared back. The salad oil scandal became a textbook example of how a rational, business-focused analysis of value can lead to spectacular returns when the market is consumed by fear and focused only on the price. The psychological principle being exploited here is a powerful defense against two of the most destructive biases in investing, anchoring and herding. Anchoring is our tendency to rely too heavily on the first piece of information offered when making decisions. In investing, the most common anchor is the current stock price or a recent high price. People will say, the stock is down 30% from its highs, it must be cheap. Or they'll anchor to their own purchase price, refusing to sell a losing investment until it gets back to even. These anchors are completely irrelevant to the only thing that matters: the business's intrinsic value. A stock down 30% from a ridiculously overvalued high is still ridiculously overvalued. The act of calculating your own estimate of intrinsic value time before you look too closely at the stock price is a powerful de-anchoring technique. You are creating your own rational anchor based on business fundamentals rather than passively accepting the market's irrational one. Herding is our deep-seated instinct to follow the actions of a larger group. It was a useful survival instinct on the savannah. If everyone is running, you should probably run too, as there might be a lion nearby. In financial markets, it is a catastrophic instinct. When everyone is panicking and selling, like they were with American Express, the herd instinct screams, sell. When everyone is euphoric and buying a hot stock, it screams, buy. The value investor must consciously fight this urge. They must, as Buffett says, be fearful when others are greedy, and greedy when others are fearful. Having a firm, well-researched conviction in a company's intrinsic value is the only thing that gives you the courage to stand apart from the herd. When the price of American Express was collapsing, Buffett was able to buy aggressively because his anchor was his $60 valuation, not the panicked selling of the crowd. This emotional fortitude, this ability to act contrary to the herd, is not possible without a deep-seated belief in your own independent analysis of value. The practical blueprint for this is what we'll call the back-of-the-envelope valuation. This is not about creating a complex 100-tab spreadsheet. The goal is to arrive at a rough, conservative estimate of a business's worth using a method that focuses on its true earning power. The key is to calculate what Buffett calls owner earnings. This is a more realistic measure of a company's profitability than the reported net income figure, which can be distorted by accounting conventions. The formula is simple. Start with the company's reported net income. Add back non-cash charges like depreciation and amortization. Then, subtract the average annual amount of maintenance capital expenditures, the amount of money the company has to spend each year just to maintain its current level of business, to replace old trucks, fix up stores, etc. This number, owner earnings, represents the pile of cash the business truly generates in a year that is available to be distributed to the owners. Once you have a conservative estimate for this number, you can put a value on the business. A simple, common-sense approach is to ask what multiple of these earnings a private buyer would be willing to pay for the whole company. For a stable, high-quality business, a multiple of 15 times owner earnings might be reasonable. This is equivalent to an earnings yield of about 6.7%, which is a decent return on an investment. So if a company has owner earnings of $1 billion, a reasonable private market value might be around $15 billion. Now, you look at the stock market. If the company's total market capitalization is only $10 billion, you are being offered the chance to buy the business at a 33% discount to its private value. You have a significant margin of safety. This simple back-of-the-envelope process forces you to anchor your decision in the reality of the business's cash-generating power, liberating you from the hypnotic allure of the fluctuating stock price. The antithesis to this rational process is the price follower. This person is the polar opposite of the value investor. Their entire decision-making framework is based on the stock's price action. They are the person who buys a stock because it has gone up a lot, believing in the greater fool theory that they can always sell it to someone else at a higher price. They see a stock hitting new highs and feel the pull of momentum. They buy, often near the top. Conversely, they are the person who sells a stock because it has gone down. They see a 20% drop, and without any analysis of the underlying business value, they panic and sell to cut their losses. The price follower's mantra is, "The trend is your friend," but they forget that trends always, eventually, end, often violently. They are buying high and selling low, the exact opposite of the recipe for investment success. They are the people who sold American Express at $35 in 1963, and the people who bought speculative tech stocks at absurd valuations in 2021. They have no concept of a margin of safety because they have no concept of intrinsic value. Their only anchor is the price, and when that anchor proves to be made of sand, their portfolio is shipwrecked. They are perpetually buying yesterday's winners and selling them after they've become today's losers. A strategy that guarantees the transfer of wealth from their pockets to the pockets of the patient value investor. The direct financial connection here is the mathematical power of the margin of safety. The margin of safety does two things for you. First, it is a defensive tool. If you buy a business for 60 cents when you believe it is worth $1, you have a 40-cent cushion. If you were wrong in your analysis and the business is only worth 80 cents, you still haven't lost money. If the company hits a rough patch and its value temporarily declines to 70 cents, you are still protected. It provides a buffer against the inherent uncertainty of the future. But second, and more powerfully, it is an offensive tool. When you buy at a significant discount, you have two sources of potential return. You get the return from the growth in the underlying value of the business over time, but you also get a massive kicker if and when the market recognizes its mistake and the price-to-value gap closes. If you buy that $1 billion earning company for a market price of $10 billion and over 5 years its earnings grow to $1.5 billion, its intrinsic value might grow from $15 billion to over $22 billion. But if the market sentiment also improves and investors are now willing to pay the full private market value multiple of 15, your $10 billion investment will be worth $22 billion. Your return is massively amplified by the double-barreled effect of business growth and valuation re-rating. This is how multi-bagger returns are generated. It all stems from the initial discipline of demanding a significant discount between the price you pay and the value you get. We now arrive at the fifth and final pillar, a principle that may seem counterintuitive in a world that glorifies action and constant activity, the inaction imperative. A private equity firm might look at 100 deals a year and only pull the trigger on 1 or 2. They have no fear of missing out. They are perfectly happy to sit on cash and wait patiently for the perfect pitch, the one opportunity that meets all their rigorous criteria. This discipline of saying no is one of the most powerful, yet least appreciated skills in investing. The average investor feels a constant pressure to do something. They check their portfolio multiple times a day. They read a news story and feel compelled to buy or sell. They mistake activity for progress. The owner-minded investor understands that great opportunities are rare and that the key to superior long-term results is to swing hard only at the fat pitches and to let all the marginal ones go by. This requires building a system that defaults to no. The classic Buffett story that illustrates this principle is his investment in Coca-Cola. It might seem odd, as Coke is now synonymous with Berkshire Hathaway. But the truth is, Buffett waited for decades to buy it. He had understood the power of the Coca-Cola brand since he was a child, observing people's loyalty to the product. He knew it was a wonderful business with a global moat. In his 1980s shareholder letters, he wrote about it, analyzed it, and praised it as the ideal type of business to own forever. Yet, for years, he didn't buy a single share. Why? The price was never right. The value was obvious, but the price in the stock market did not offer him the margin of safety he required. He was content to watch it, admire it, and do nothing. He put Coca-Cola in what he and Munger call their too-hard pile. Not because the business was too hard to understand, it was brilliantly simple, but because the valuation decision was too hard. The price was too close to its intrinsic value to offer an obvious bargain. Then came October 19, 1987, a day known as Black Monday. The stock market crashed violently, with the Dow Jones Industrial Average falling over 22% in a single day. It was a day of pure, unadulterated panic. The herd was stampeding for the exits. Fear was everywhere. In the weeks and months that followed, the volatility continued, and the prices of even the highest quality companies were dragged down. Coca-Cola, whose business of selling sugar water was completely unaffected by the stock market crash, saw its stock price fall significantly. For Buffett, this was the moment he had been waiting for patiently for years. The fat pitch was finally coming over the plate. The market's panic had finally created the disconnect between the price of Coca-Cola stock and the value of its unshakable global business. Over the next several months, into 1988, Berkshire Hathaway began buying Coca-Cola stock aggressively, ultimately investing over $1 billion to acquire a roughly 7% stake in the company. It was one of the largest single investments he had ever made. This wasn't a rash decision. It was the culmination of decades of patient observation and disciplined inaction. He knew the business intimately. He trusted the management. He understood its durable moat. And now, finally, the price was right. That $1 billion investment is now worth well over $25 billion, not including the billions upon billions in dividends Berkshire has received over the years. This legendary return was not earned by brilliant activity. It was earned by brilliant inactivity, by the discipline to say no for years. so that he had the capital and the conviction to say a very big yes when the perfect moment arrived. The underlying psychological principle here is a direct assault on action bias and the fear of missing out, or FOMO. Action bias is our innate tendency to favor action over inaction, even when inaction is the more rational course. In ambiguous situations, our brain tells us that doing something is better than doing nothing. For investors, this manifests as a constant need to tinker with their portfolio. The market is up? Maybe I should sell something and lock in a profit. The market is down. Maybe I should sell to prevent further losses. This compulsive need for action almost always leads to worse results. FOMO is the social and emotional anxiety that you are missing out on a rewarding experience that others are having. In investing, it's seeing a stock price soar and feeling an irresistible urge to buy it, not because of any fundamental analysis, but simply because you can't stand the thought of others getting rich without you. This is the emotion that fuels bubbles and manias. The discipline of the too hard pile is a powerful cognitive tool to combat both of these biases. By explicitly creating a category for ideas that are either too difficult to understand or not attractively priced, you are giving yourself permission to do nothing. You are reframing inaction not as a failure or a missed opportunity, but as a deliberate, intelligent, strategic choice. It transforms patience from a passive state of waiting into an active process of filtering. You are not just not buying, you are actively deciding not to swing. This builds discipline. The patient investor who sits on cash or treasury bills is not losing money relative to inflation. They are paying a small price to maintain their option to pounce when a true bargain appears. The compulsive tinkerer who is always fully invested in mediocre ideas has no cash available when the market crashes. They are forced to sell one of their mediocre holdings, likely at a loss, to fund the purchase of a great one. The disciplined investor, like Buffett in 1987, has the cash ready. Their patience has armed them with the most powerful tool in investing: liquidity in a time of crisis. This leads to a portfolio that is far more concentrated in its best ideas. Instead of owning 50 stocks you feel okay about, you might own 10 to 15 businesses you understand deeply and bought at a great price. This concentration of capital in your highest conviction ideas is, historically, how the greatest fortunes in investing have been built. The inaction imperative is the discipline that makes this possible. It ensures that when the fat pitch arrives, you don't just have a toothpick in your hands, you have a giant bat and the strength to swing for the fences. You have just been given a powerful weapon. This framework, the owner's mindset, the 10-year test, the people equation, the price-to-value discipline, and the inaction imperative, is not just a collection of tips. It is a complete, coherent operating system for making rational decisions in an irrational world. You now possess the mental toolkit to transform yourself from a stock renter, tossed about by the whims of the market, into a business owner, a patient, long-term partner in wealth creation. You have learned to ignore the noise, to focus on the fundamentals, and to wait for the pitch you know you can hit out of the park. This is a profound advantage, one that will serve you for the rest of your investing life. But it is crucial to understand that what you have just mastered is a single, powerful node in a much larger network of interconnected mental models. You have acquired the system for answering the question, what business should I buy? This is the foundational skill of fundamental analysis. However, it exists within a broader strategic landscape. Knowing what to buy is only part of the equation. Just as critical are the questions of portfolio strategy and risk management. How does one great business fit together with another? How do you think about position sizing, about how much of your capital to allocate to a single brilliant idea? When, if ever, is the right time to sell a wonderful business? These are not secondary questions. They are the links that connect a collection of good investments into a resilient, anti-fragile, wealth-generating machine. The video that is now on your screen is the next piece of that map. It is the bridge from the analysis of a single company to the architecture of an entire portfolio. It takes the principle of the owner mindset and elevates it, showing you how to think not just as the owner of one business, but as the CEO of your own personal holding company. It is the crucial link that connects everything you've just learned about business analysis to the larger, even more important science of portfolio strategy. The choice you face right now is not merely about watching another video. It is a decision about your identity. Will you remain a collector of interesting ideas, or will you continue the ascent to become a true capital allocator? The journey to mastering your financial destiny is a step-by-step process of building your mental arsenal. You have just forged the sword. Now is the time to learn how to wield it as part of a complete strategy. Continue your ascent. Complete the arsenal. Click the video.